Hello friends, in this presentation we shall discuss ECGC and transit insurance. We welcome you to this project of learning export and import trade. Enjoy learning. Thanks. In export, we require risk coverage on non-payment of export proceeds by the buyer and to provide credit to the overseas buyer. Is credit extending to importer safe? How can an exporter provide credit to unknown buyer? What is the remedy to provide credit to an overseas importer? What is ECGC and how ECGC protects exporters? What is ECGC? ECGC is essentially an export promotion organization seeking to improve the competitive capacity of Indian exporters by giving them credit insurance covers. The insurance is comparable to those available to their competitors from most other countries. It keeps its premium rates at the lowest level possible. What does ECGC do? ECGC provides a range of credit risk insurance covers to exporters against loss in export of goods and services. It offers export credit insurance covers to banks and financial institutions to enable exporters to obtain better facilities from them. ECGC provides overseas investment insurance to Indian companies investing in joint ventures abroad in the form of equity or loan. How does ECGC help exporters? Offers insurance protection to the exporters against payment risks, provides guidance in export related activities, makes available information on different countries with its own credit ratings, makes it easy to obtain export finance from banks or financial institutions, assists exporters in recovering bad debts, provides information on creditworthiness on overseas buyers. Need for export credit insurance. Payment for exports are open to risk even in the best of times. The risks have assumed large proportions today due to far-reaching political and economic changes that are sweeping the world. An outbreak of war or civil war may block or delay payment for goods exported. A coup or an insurrection, that is violence against government, may also bring about the same result. Economic difficulties or balance of payment problems may lead a country to impose restrictions on either import of certain goods or on transfer of payment for goods imported. In addition, the exporters have to face the commercial risk of insolvency or default of buyer. The commercial risks of a foreign buyer going bankrupt or losing his capacity to pay are aggravated due to the political and economic uncertainties. Export credit insurance is designed to protect the exporters from the consequences of the payment risks, both political and commercial, and to enable them to expand their overseas business without fear of loss. Procedure with ECGC to cover the insurance. Once after finalizing the order, the buyer executes a purchase order to the seller with the terms and conditions as agreed by both. The purchase order should contain full details of buyer and buyer's bank account. The exporter approaches Export Guarantee Corporation to get the approval on the buyer with the amount of limit. Here, ECGC, with their available contact with overseas networks, find out the credit worthiness of the said buyer and arrives at a figure of credit worthiness and inform the maximum limit of amount that can be shipped at any point of time. Export Credit Guarantee Corporation collects premium on the amount of the approval and issue insurance policy accordingly. The exporter can apply with ECGC for insurance on the shipment-wise order as specific insurance policy or at lump sum as comprehensive policy. If an exporter obtains the specific policy, the contract of insurance is only for the particular shipment. You as an exporter have to pay premium only against the said shipment. If you prefer to obtain comprehensive policy against any buyer, you can get approval from ECGC the amount of credit worthiness of the said buyer. Transit insurance or the marine insurance. Marine insurance is concerned with overseas trade. International trade involves transportation of goods from one country to another country by ships. There are many dangers. During the transshipment, the persons who are importing the goods will like to ensure the safe arrival of their goods. Transit insurance or marine insurance. The shipping company wants the safety of the ship, so marine insurance ensures the coverage of all types of risks which occur during the transit. Marine insurance may be called a contract whereby the insurer undertakes to indemnify the insured in a manner and to the extent thereby agreed upon against marine losses. Marine insurance has two branches: ocean marine insurance, inland marine insurance. Ocean marine insurance covers the perils of the sea, whereas inland marine insurance is related to the inland risk of the land. Marine insurance is one of the oldest forms of insurance. It has developed with the expansion of trade. It was started during the Middle Age in Italy and then in England. The sending of goods by sea involves many perils, so it was necessary to get the goods insured. In modern times, marine insurance business is well organized and is carried on scientific lines. Principles of marine insurance. The principles of all type of insurance are generally the same. Utmost good faith. The marine contract is based on utmost good faith on the part of the parties. The burden of this principle is more on the insured than on the underwriter. The insured should give full information about the subject to the insured. He should not withhold any information. If a party does not act in good faith, the other party is at liberty to cancel the contract. Insurable interest. Insurable interest means that the insured should have interest in the subject when it is to be insured. He should be benefited by the safe arrival of commodities and he should be prejudiced by loss or damage of the goods. The insured may not have an insurable interest in the time of acquiring a marine insurance policy, but he should have a reasonable expectation of acquiring such interest. The insured must have insurable interest at the time of loss or damage, otherwise he will not be able to claim the compensation. Indemnity. This principle means that the insured will be compensated only to the extent of loss suffered. He will not be allowed to earn profit from marine insurance. The underwriter provides to compensate the insured in the cash and not to replace the cargo or the ship. The money value of the subject matter is decided at the time of taking up the policy. Sometimes the value is calculated at the time of loss also. Cause proximal. This is a Latin word which means nearest or approximate cause. It helps in deciding the actual cause of loss when a number of causes have contributed to the loss. The immediate cause of the loss should be determined to fix the responsibility of the insurer. The remote cause for a loss is not important in determining the liability. If the proximate cause is insured against the insurer, it will indemnify the loss. Thanks.